Well, good evening, everybody, and welcome to the September 2020 edition of the Roundtable. We'd like to welcome you to the auditorium here tonight, where the four of us will be taking questions from Chris Wallace and no, that's the other guys. No, we actually moved. This is one of the rare times we've had to move a session because of to get out of the way of the presidential debates here in a couple of hours, and we do look forward to having a good time and stepping lively through a number of things, but welcome. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and we are joined here by Ken Kavula. He is a longtime contributor to the Mid-Michigan chapter in this area and a renowned national presence. Good evening, Ken.
Good evening. Makes me sound older than I actually am, and I'm already older than dirt, so...
And the second guy from the left, you can see he's already ripped off his tie, and he's preaching. Welcome, Cy Lynch from Atlanta. How are you doing tonight, Cy?
Doing well, everybody.
And third, Hugh McManus from the beaches of California. Are the skies still orange out west, Hugh?
Not anymore. They've all cleared up. The air is still a bit stinky. I bet it smells like it did back in the days of steam engines.
Yeah, I can remember landing there a few years ago. It just made my eyes water. It's
it's not pleasant in the morning.
Yeah.
Not as bad as it was. Still, please,
right.
We'd be grateful for a rain shower. So, anyone's got any rain they don't need, let us know.
You bet. Well, let's go ahead and get underway. We're here to share some ideas, so let's get with it. Get the legal stuff out of the way first. No investment recommendation whatsoever is intended. This is about education and demonstration. Demonstration is one of our favorite words. This is all about illustration of the philosophies and methods and techniques used by the modern investment club movement, whether it's NAIC Better Investing or Manifest Investing or George's Kitchen approach, whatever, as long as it's consistent with the lessons of the modern investment club movement. All opinions expressed are ours, and we try to disclose when we own the companies that we talk about. If you would like an email reminder, we do a number of events, including what we call bull sessions that happen every Tuesday, investing topics, and then these monthly webcasts. You can send a note to nkavula1@comcast.net if you'd like to be made aware of stuff as it happens. If you'd like a copy of the slides, or if you have follow-up questions, you can send me an email, markr@manifestinvesting.com. Here's our agenda. We've been doing this for over 10 years now. The agenda is pretty much the same. Again, if you're here for the first time, big, extra strong welcome to you and a big hug. We do try to keep things fairly informal. For the hundreds of you that have been here before, good to see you again. Welcome back. We do keep track of how well we do. We'll talk about that briefly in the performance results. We do have a couple of stocks on the so-called hot seat. Then you see the 4 stock presentations from SiriusXM to Truist. That's a true homer selection down there in Georgia. And BP and Universal Health Services, that's UHS. We do an audience poll at the end of the stock presentations. I don't know if we'll talk much about the presidential cycle or that kind of stuff, but if there is any open time, we might have a bit of discussion, but we do leave the floor open if we do leave any time for questions at the end. And I mentioned philosophy just on one slide ago. I just love this quote from one of the leaders at Hillsdale College, love of wisdom, and pretty interesting quote. And it really is the type of thing that we collectively chase in this community of investors. We pursue success in investing, and we try to pursue it together. And it's a rather important characteristic of our community and the things that we do. Any comment or questions, Ken?
No, we do have a couple of hands raised that I'm going to go to real quickly. Martha, your hand is up, and I cannot unmute you because you're muted yourself. So I'll go to Fred. Fred, you're self-muted as well, so you'll have to unmute yourself if you want to say something. And the same thing for Haney. Haney, you're self-muted, so gentleman or lady, if you unmute, then you can speak to us because I've unmuted you as well. They look like inadvertent hands, Mark, so let's continue with the process, okay?
Is that Fred from St. Louis?
It's Fred from St. Louis, I think,
Go Cardinals.
There we go, Tammy. Tammy, you're unmuted. Did you have a question? No, Tammy just ran from the unmute. So, Fred, I'll give you one more shot at it. You're self-muted. If you unmute, you can speak to us, Fred. Okay, let's just continue, Mark, all right?
All right. Like I said, we've been doing this for over 10 years. It really is a group of friends and coming together and talking about actionable investment opportunities. The word actionable to us means go home and do your homework. It doesn't mean call your broker. We keep track. We do try to beat the general stock market as measured by the Wilshire 5000 by 5 percentage points over the long time. We are succeeding in doing that, and we'll talk about it. And we do like to see the majority of our selections beat the market. Here's a quick look at the roundtable performance. Again, a little over 10 years. This is actually the annualized rate of return, checking in at 17%-ish. We actually peaked out before the swoon in at the end of August and throughout much of September. We got pretty close to 18% since inception of this portfolio. When you hear the phrase relative return, all we're talking about is the performance of the actual portfolio when compared versus exactly identical investments made into the Wilshire 5000 index fund. So that difference would be the relative return. And again, we're aiming for at least 5. That's kind of a modern investment club objective. Here's another way to look at the progress over time. This is what many of you are more familiar with over time. Our actual return, rate of return is 17.2. The Wilshire 5000 checks in at 10.9 this evening. So we are back, bumped up above 6 percentage points. We're at 6.3 percentage points better than the Wilshire 5000. And that's pretty rare company. That's doing pretty well, and we enjoy that. About half of our picks, this 48.1%, have beaten the market. And then just one other quick tidbit. We use a tracking portfolio. It's not the same as a regular investment club portfolio or most individual portfolios, where we actually keep track of the cash flows. And what it comes down to is the net of our selling decisions. We've been, again, $1,000 into every decision that we make. We've invested $571,000. You'll see in a second we've got about $370,000 balance, but we've actually taken out $64,000 more than we've put into the portfolio. I mean, wrap around that one for a little bit. When you think about it, we've taken out more than we've put in, and the balance is $360,000. It's kind of fun. Kind of fun when that happens. Any comments or questions, Ken?
No, things are moving smoothly in the back room right now, Mark.
Okay. Here's the portfolio. It's a public portfolio. You can reach it looking at this link. These are the top 20 holdings in the portfolio by percent of assets from number 1 down through 20. What we do is every time it is selected by a knight, a guest damsel, a guest knight, or the audience, we invest $1,000 into the position. So in the case of Microsoft, and this is how you use the legend here, Microsoft has actually been selected 5 times, I think mostly by Hugh McManus. So $5,000 invested in Microsoft is now worth $46,000. So that's how you read the key, and it's fun to kind of go down that list, and especially some of those one-timers or two-timers that are now contributing a fair amount of cash to the portfolio, value to the portfolio. One comment that I will make in summarizing the performance over the last month, we have not lost ground in September. In other words, while the market has swooned several percent, we actually stayed pretty level with where we were a month ago, down a couple $1,000s, but nothing significant. That's why we're having trouble keeping the par 5 points ahead of the market average, which is Tonight it's 8.7%. Did you want to talk about that a little bit, Ken?
Well, I just want to make it clear what the arithmetic, how the arithmetic works. That just means that we're picking really good stocks and they're doing really well. And they don't have as much room for future appreciation because the appreciation is happening right at this moment. We're going to have to keep pushing them off the bottom, the low part of the par list, and trying to add some more to the top part to keep that number moving towards +5 if we can do that. And it's a noble goal, and as long as we're moving in the right direction, I'm not worried about this portfolio. I really like to see that our sales growth column, Mark, is at 12% right now. We could stand to move that up even another, quarter, 0.3%, but I'm very pleased to see it at 12. I can remember a year and a half, 2 years ago, we were down around 9.5, 10% in sales growth, and we were having some real trouble trying to keep this thing moving forward. So we've learned our lessons well, and we're continuing to follow what we know has to happen in order for us to meet the goals we've set.
Okay, we'll keep pushing along here. Speaking of selling the ones that are on the bottom, we have a celebration tonight. Several months ago, Cy and I actually backed out of our positions in Simulation Plus, and we left the audience behind. This is one of the top performing selections in the history of the Roundtable. $1,000 has become $3,600 in a fairly short amount of time, and it will rank in the top 10 all-time closed-out positions when we close it out. Just closing it out because it has the lowest par. We can always come back to it if we get a nice volatile speed bump in a company like Simulations. We're going to take a look at the visual analysis here in a second, but that's not a sell recommendation on Simulations Plus, and I'll let Ken expound on that in a minute. I am going to back out of my position in Skechers because it's just not working out. So rule of 5, that's just not working out, and then we'll just move on. And we do that to protect ourselves in the clinches. So there are no positions that are showing dramatically overbought positions. So we'll just leave it at that, exiting those two relatively small positions and go from there. Ken, would you like to spend a moment talking about Simulations Plus over the years and your perspective on it right now?
Yeah, this has been a company that I've been following for a long period of time. I first brought it to the National Convention maybe 8 or 9 years ago, told the story of how I discovered it. You don't need to hear that again. But it's been a nice, consistent grower, as you can see by the top graph, and the earnings have kept pace with that growth consistently again. PE ratios, as the market discovered that this company was offering growth at a fairly reasonable PE value, the PE did tend to expand. So the PE is a little rich right now. The par is a little bit low because the stock has been moving so quickly in an upward direction. And there's not a darn thing wrong with this company. If there should be a major pullback, this is the kind of company that I would want to take a real serious look at going forward. Mark pointed to the I bars. That's on the blue graph. That's the little vertical lines that talk about 52-week high and low. If you kind of squint and then connect the tops of those bars, you'll notice that the tops of the I bars graph are aligned a little bit steeper than the earnings per share line itself. What that is showing is an increase in PE value, and we can see that on the bottom graph as well. We're only picking a single PE value on the bottom there, but you can see that trend upward without too much trouble. All in all, I think it's a good one to set aside and to freeze for the moment, and it's also a great company to keep an eye on as we move forward.
Absolutely. So let's go ahead and take those actions and never let this one drop off the radar screen for future opportunity. Ken, do you want to go ahead and let the cat out of the bag again?
Yeah, I'd like you to save the dates, folks. I'd like you to save November 11th, 12th, and 13th. For 16 years in mid-Michigan, we've run a stock pickers contest, and this year we're not going to be able to run it. So we're going to bring it to our members remotely. Only we're going to bring it to them in a 3-day affair in the late afternoon on those 3 days, November 11th, 12th, and 13th. Right now, all we're asking you to do is save the date. And in the next couple of weeks, everybody on our reminder list will get detailed information about the conference. It'll be very similar to the conference we did last May. We got a lot of really, really kind words about that conference and a lot of real positive feedback. So we're going to run something very similar to it again. The times around 1 in the afternoon till around 4 in the afternoon on those 3 days. That's Eastern time, and we are going to do a lot of classes which we think are practical and which will give you some great ideas to add to your list of stocks to study.
Yeah, we're sure to cover some of our small company selections at that point that will have just been made post-Halloween. So we'll be doing that. And with great humility, I point out that we have had very successful picks from our panel in the May session, and we'll talk about who's on that panel as we close down things tonight. But I will give you a tease. Talked about it this afternoon for people who came to the bull session. Pat Donnelly from Pittsburgh picked a company by the name of Stone Co. back in May. The ticker is STNE. I would invite you to go back, take a look at a stock price chart on Stone Co. Again, the ticker is STNE, and let's just hope that Pat brings another one of those come November. Anything else, Ken, before we press on?
No, I have a couple of questions, but I'm going to save a few of those to the end. Okay.
Okay. Well, I'll go ahead and kick us off tonight. I'm not sure whose body I borrowed for the podium shot on the right, but again, what I really like to do, much in the spirit of Hugh McManus, is look for companies that have been kind of beaten up and beaten back, but that rank among the companies that have the best potential out there. Now, many of you are familiar with our work on projected return on value. That's this middle column, owners' projected return on value. And what I basically am looking at is this distribution of companies down at the bottom here. And these are the companies in the Value Line Investment Survey, the standard edition. And what I'm looking for is companies that are out in these, higher potential positions out on the right-hand side of what to me looks a little bit like a pretty nice looking bell curve. So that's the companies that are coming to the forefront here. I limited it to companies that have excellent quality, double-digit projected return on value, and then I love to find companies that are down in the 20s and 30s when it comes to the relative strength index. And I'm going to go ahead and go right with the first one at the top. These are all good studies. Some of these have been featured by a number of us at presentations. They've been part of the roundtable tracking portfolio at some point during the 10 years. So there's a number of companies on there that merit further study. I'm going to go ahead and go with SiriusXM, ticker symbol SIRI. It's got a decent projected annual return according to the analysts. It's got a relative strength index, which is suggesting that it might be oversold, and maybe a little bit pessimistic when it comes to the institutional rhinos and all that kind of stuff. It's down pretty close to Hughes, 20% on the proximity to the 52-week low. But notice Value Line has high expectations. Morningstar has a price to fair value of 90. The analyst consensus is particularly optimistic about Sirius with their 69. So that's basically saying that they think that it's got a 30% red tag hanging off of it. And I'm also compelled by the fact that the next year looks pretty good in terms of potential. All right. I think most people here know the company that lives on your radios and a number of devices. It's made up of two major components now, the Sirius entertainment assets that they have and Pandora, mostly music, talk talk radio type stuff, some sporting things. You can see Lady Gaga in the middle of the screen there. And you can see the value line closing paragraph from July. And again, they're looking for this company to have fairly decent long-term projections. It got stung by the pandemic, even though their businesses was not significantly impacted. Now, the sale of new automobiles has some impact on them, but we're actually seeing pretty good signs of pickup. In fact, anybody out there that's on the fence as to buying your next car, we encourage you to do that in Michigan. We're always grateful when you go out and help us. Those of us that live near Detroit, then you go out and buy a Chrysler would be a really good idea. Jeep works, and all the Jeeps have Sirius in them, so good stuff. I do have to disclose a personal bias here. I have been privileged to spend time with Sirius company representatives, including some of their executive management at the Consumer Electronics Show in a couple of years. Due to my wife's occupation, she makes dashboards for Chrysler and Jeep, and so they have interface with these companies on a fairly regular basis. So I do have a bit of a personal bias that you should know. Here's a look at the company. The visual analysis is basically reflecting the fact that Pandora was added to Sirius at that point in time. So we're really paying attention to 2019, 2020, and the analyst estimates going forward for the next couple of years. Really decent consumer product type growth rate, a little bit low for some of the expectations that we have, but we're looking at an $8 billion company that's well positioned and well leveraged into a number of consumer slots all around the country, growing at 5%, becoming a $10 billion company in the next 5 years or so. Really nice profitability. You can see the 30% range. The value line is expected. Don't even need that to be successful here. In my own study, I would probably end up somewhere in this range with what they have done with Pandora, and once they get all the stuff cranked in, somewhere in the low to mid 20s for net profit margin, and that would be fine too. And the PE ratios, again, a little bit frisky, but not too bad. So we end up with a company that has a very high projected return based on that 5% growth, very high margins, and robust PE ratios. Now, they do have liabilities, and they've got a decent amount of cash in the checkbook, but that projected return on value that we talked about, the average projected return on value for a company is 6 or 7% right now. So that's looking pretty good. It's looking pretty good to me, and it's a check on the PE-based projected annual return. They have been controlling their debt fairly carefully. Here's that relative strength index that is suggesting that it may be oversold. And again, I'm seeing very nice numbers here reflecting potential extra value. Now, this is not a company, I'll make a pledge. I promise not to marry it or fall in love with it if it stumbles or if it succeeds and basically delivers a nice return. You know, a fairly recent example would be the Wolverine that we bought a few months ago for Tin Cup, and it basically doubled in 2 or 3 months, and we sold it from that portfolio, not because we don't like Wolverine. We just simply think that when a company like that makes a move like that, you take advantage. So I'm going to go ahead and add Sirius to the tracking portfolio. With that, I'll turn it over to the guy who tore his tie off and is rampaging around the stage. The debate moderator is probably trying to rein him in. But take us away, Cy Lynch, with your
All right.
hometown bank.
Thank you, Mark. And not only am I running all around the stage today, I'm bringing a pick as American as mom and apple pie, or perhaps Coca-Cola and baseball, and for all of us, investing as well. So let's take a look at Truist Financial. If you don't know the name, you're not alone, but it is the name of the merged BB&T Bank and SunTrust banks. Here, I'll just point out a quick screen here. Notice that the projected low return. Back to the
Oh, I'm sorry. Sorry, Si.
value line. There you go. The low return of 12%. That's a little below our projected return and our goal, but it's right in line, and it's a good solid potential return. And notice the 18-month potential return of a little over 50%. So, value line is saying it's certainly a stock to study. Let's move on. This month I got to Truist in a little bit of a convoluted fashion. I ranked the roundtable portfolio by par, and First Financial Bank shares kind of jumped out at me. I've, of course, have suggested it before, and I think Ken did last month, and it looks attractive, but I said, let's just consider another bank company. So I went into the regional banks. Next slide. Ranked them by projected yield. I usually don't pay a whole lot of attention to yield, although when you're looking at financial stocks, bank stocks in particular tonight, yield can be a significant portion of the return. So I decided to rank by yield. Just take a look at what popped up, and I've condensed the slide a little bit for the screen, but Truist Financial is the highest yielding stock with the blue-green, the excellent quality rating and sweet spot par. You see U.S. Bank Corp there just a notch farther down with a little bit less return and a little bit less yield. Next slide. So I again ranked by financial strength, again with the markets at near all-time highs, bouncing around, and just the general uncertainty that we're facing. I'm trying to ratchet up my quality a little bit. The yield helps me do that, gives me a little bit of a buffer underneath the stock price. Ranking by financial strength, again, you see U.S. Bank Corp right there, and Truist is, again, the highest high quality and par stock. You see First Merchants and First Financial Bank shares also are in the blue-green category on this list, have very solid financial strengths, but their yield's a little bit lower. So all of that says, let's look at Truist. Next slide. I've already mentioned that Truist is the combination of SunTrust, BBT, Apple Pie, Mom, Coca-Cola, and baseball. I should have put the Coca-Cola symbol on here, but if you don't know the history of the company, I'll explain where the Coke connection is. SunTrust was formed about 20 years ago or so with a merger of Sun Banks from Florida and a trust company bank, a hometown Atlanta bank, a long-standing Atlanta bank. Headquartered was right across the street from my first office in Atlanta in downtown. And Trust Company was the investment bank that brought Coca-Cola to market back in the early 1900s. And in fact, much of the capital of Trust Company for many years was Coca-Cola stock. So that is the Coca-Cola connection. It's now SunTrust, and then of course after the merger with BB&T, Truist, and we'll see baseball in just a minute. Here's some slides from the latest company investment presentation. Leading financial institution. This is actually all banks. Notice by market value, by assets, by loans and deposits, it runs either fifth or sixth. And each of these top 10 banks, they all stay the same. They just shift a bit in ranking. U.S. Bank Corp and Truist are still considered regional banks. They're not yet international money center banks like the first four on the list are considered. So they don't have quite the same level of some of the regulation for too big to fail if you recall all of that from the Great Recession. Next slide. They have high ranks of deposits in fast-growing areas. You'll see another slide that shows fast-growing areas in a little bit more detail, but notice the Sun Belt emphasis and how the bank ranks in the top 3 within the states there on the eastern seaboard: Georgia, the Carolinas, Florida, Tennessee, Virginia areas. Next slide. Here are the 10 fastest growing markets in the United States, and SunTrust has a significant presence in all of them. Truist has a significant presence in all of them, with the exception of Phoenix, Denver, and Seattle. Truist is not a West Coast bank. It's Southern and Southeastern. Next slide. Here's Truist's year-to-date performance. This is the merged entity. When we get to the stock selection guide, we're going to be using largely BB&T data with the and then launching off the merged numbers. But this is merged numbers, and you see return on assets for Truist is above its peers. Return on equity is as well. Notice also, very important for banks is the efficiency ratio. This is the non-interest expenses and how it compares. Truist, again, is below its peers, has a good net interest margin. That's how much money they're making on loans. And then their non-performing assets as a percentage of assets. Now, again, Truist does have exposure to companies that are potentially impacted by COVID-19. So that is a risk. They've been boosting their loan loss provision to help try and cover that. But BB&T brings a very conservative lending philosophy into the merged bank. So it's a very conservative lending bank. Next slide. And here's the baseball connection. SunTrust Park is now Truist Park, home of the Atlanta Braves. And so, again, how can you go wrong with mom, apple pie, Coca-Cola, and baseball? One last thing that I will mention about the company, it is a bank. However, about half of total revenues come from non-banking or non-loan related income, non-interest income. BB&T brings the world's 5th largest insurance brokerage into the mix, and SunTrust brought the trust company investment banking into the mix. So the company is certainly impacted by loans, certainly impacted by interest rates. In a record low interest rate environment, that's something you want to be aware of in buying banks. However, about half of Truist revenues come from non-loan related activities, so they're not as sensitive to interest fluctuations. Next slide.
Si, I feel compelled to make a disclaimer on your behalf. You did sneak Home Depot onto the slide, and you are a shareholder in Home Depot?
Yes, I am. I'm not a shareholder in Truist. I am a shareholder in Home Depot, and also probably SunTrust or Truist Park, since I give them a few $1,000s a year to be able to sit there, although I wasn't able to do that this summer. Here are the judgments. I projected a 4% sales growth. This is using the Morningstar and Better Investing way of calculating revenues for a bank, which is net interest income plus non-interest income. And that's 4% is a little bit above the BB&T rate coming in, but certainly appears reasonable for the company. Gives me a $4.07 projected shares 5 years out, or earnings per share, and that's compared to Value Line's $4.60 and Manifest 95. I projected an average PE of 13.8% based on a high of a high of 16 and a low of 11.5. Next slide. And here's the bottom line. Notice the current yield is at 5%. Very solid yield. I'm projecting an average yield over the next 5 years of 3.3, which certainly is solid, and there is room if they boost the dividend for that to grow. And it gives me a potential annual rate of return of 12.5% using the average PE ratio. So I suggest I am adding Truist, and suggest that we double down on it. Mom, apple pie, baseball, and Coca-Cola.
Oh man, he's harvesting ballots now. Great. All right, let's switch gears to Hugh out on the West Coast and his infatuation with BP, and take it away, Mr. McManus.
Thank you, Mark. Yeah, you see, that looks kind of scary, doesn't it? It's not very good if you own a company and it's doing that kind of thing, discovering where the center of the earth is for an oil company. But it's a bit off-putting. But for me, it makes me happy if I want to buy it. I like to look at this kind of thing. I like to try to figure out where it's going to end. And with BP, I thought I knew that a few months ago, and it didn't end. So I tried again, and it explored another nether region. And now, actually, as Mark pointed out, it's significantly less expensive to buy a share of BP than it is to fill a tank of gas. And maybe it will start to match the price at the pump soon, but let's see if that happens. It'll never get below its dividend. At least I challenge it to do that. So my process is very similar to everyone else's. I tend to look preferentially at what I've bought before, which to some extent I would agree with Ken, defeats the purpose of an educational program like this a little bit. But I'm here to win. I'm here to have a good portfolio, and so I'm tempted to do what I do in my own life, which is to add what I already have. It's a kind of a lazy person's way of doing things. I ideally like companies to be at a 52-week or a multi-year low. And there's always bad news when that happens. A company really comes dressed up like a Christmas tree with horrible decorations on it. It stinks. All the bad adjectives you can attach to it, that company has it. And BP here is no exception. Ordinarily, I probably would have gone with a pharma company. Right now, I think Gilead and Pfizer are close to maybe even a 5-year low. So they're very tempting as well. But BP just continues to drill into the earth, and I'm there following it all the way. So next slide. There are very few slides here because really nothing has changed. BP continues to be more compelling because it gets cheaper. The stock price, as I said, has been dropping and continues to drop. But it has published news recently that it expects, reading between the lines, and you don't have to read very hard to conclude this, that it's pivoting away from being an oil company and defines itself more as an energy company. Not surprising. But I think that process will not happen, certainly not happen as quickly as analysts seem to think based on the projections for stock prices, or even BP management. There's a huge infrastructure built in the US and worldwide that has oil at its center. And that will be a slow change. I can't imagine governments will coordinate and push it away easily because it would be such a major change and impact on the economy. It's going to happen, but I think more slowly than people think and more slowly than the stock price of Tesla, for example, would suggest. When things recover, oil will continue to grow at a million barrels a day worldwide. It's now at 96 or 97, assuming that COVID wasn't around. It'll be 98, it'll go up to 99, but that growth will slow down. Renewables will become an even bigger part. And by 2050, I would imagine, at a very minimum, half of energy and maybe more will be renewables. But in the shorter term, 5 to 10 years, companies like BP have a history, a future, based on their history. So we skip on. I think that, just one last slide summing it all up. I do believe the recession will end soon, or this COVID-induced pandemonium and pandemic will end soon. Soon being within 1 to 2 years, we'll be back to normal. The pricing gets more and more inviting. BP has said that the future is going to change and not in its favor if it doesn't itself adapt to this change, which it's trying to do. But weaning off oil will take time. And in the meantime, I think that stock price will continue as oil becomes, oil prices strengthen again. So I want to fill her up with a bit of BP.
Thanks, Hugh. Yeah, in fact, I want to give a shout out to Len Douglas. I know he's in the audience here tonight. Len actually brought to our attention that you'd probably be surprised to know how much of BP's business is actually chemical related, the petrochemical business. I don't remember the percentage. Do you know off the top of your head, Hugh? It's like, I want to say 20%.
Yeah, it's a big number. Many oil companies are. I mean, as I pointed out, 90% of chemicals, and that means the fabrics that cover your household, the paint, the chair upholstery, anything that comes from the chemical industry, 90% of it originates in the oil industry. Yeah,
and so that's obviously not going away overnight either. So, good stuff. Well, thanks, Hugh. And I did ask for an exciting growth stock tonight, so you don't follow instructions well.
Well, I'm talking about the roots growing into the ground here.
There you go. All right, so let's go back to Mr. Kavula and presentation of Universal Health Services. Take it away, Ken. I don't know whose body you're on either, so have fun.
Well, he's lost weight from my regular body, so I'm pleased with it, Mark. So, okay.
Frame that and put it on your desk, man.
I will do that, okay. I'm talking about a company tonight that's been around for quite a while. 40 years is their anniversary in 2019, and yet it's not gotten a lot of publicity. It's not one that a lot of people follow very closely, and I think it gets confused with a lot of other United or Universal named companies, so that it kind of gets lost in the shadows. Let's bring it out of the shadows tonight and talk about it, okay? This is owned by one of the stock clubs that I'm in, and let me talk to you about our thesis for owning this stock and how we stumbled upon it. Next slide, Mark. The company basically has a North American presence, mostly in the United States, but it does have Canadian branches as well. But it also has a sizable presence in the UK, the United Kingdom, going as far north as Scotland and then into England and Wales. Excuse me, I think that could be something of a benefit for this company if we should move in this country towards a single payer plan, because right now the company has experience with all of its UK business with a government insurance single payer health plan in the UK. So they deal with two completely different health systems right now, but they seem to be managing without too many problems to make both succeed. Next slide. The company is almost exactly evenly split into two divisions. There's the acute care division, where they do a lot of surgery. They do a lot of things that you have to stay overnight for, and they do things where they're outpatient kind of procedures. But the other half of their business is behavior health. And we'll talk about why that has benefited the company in just a moment here. Next slide. This comes from Value Line, and the first thing that I look for when I'm looking at a company coming out of a recession is I try to mine the words of George Nicholson, who suggested that a triple play was especially good to look at as you were coming out of recession. There are three things that happen in a triple play. One, the stock price should be a little bit depressed. Well, right now I'm looking at projections according to Value Line that are in double digits, and that's usually the way that I define a depressed stock price. If I'm going to see a pretty good size total return going forward, then that means the price is probably a little bit depressed right now. So leg one of the triple play has been met. Leg two of the triple play is I like to see room for the PE to expand, and the current PE of around 10 somewhere is expected to expand to a PE of around 15 3 to 5 years from now. So leg two of the triple play, anticipated PE expansion, and that's happening. Leg three, anticipated net profit margin expansion. And if you look at these net profit lines, the last actual net profit was 7.2. Value line is looking for net profit to stay relatively consistent for this year and next year, but in 3 to 5 years to expand to 8.5%. So that's leg 3 of the triple play. And the fact that this has met all 3 legs makes it an interesting candidate for study. So study it we did in one of my investment clubs. Here's the Manifest Chronicle for this stock, and currently the par is at 10. I circled the par up there on the right-hand side, so you could move that red line up to the 10 mark. I do like to see quality that's staying consistently above 80, and this one with a little bit of swooping around 1 or 2 points in each direction. The blue quality line has certainly stayed fairly consistent, and I'm always looking for a stock that gives me a par value that's at least at the top range of where the par has been in the last 3 to 5 years. I don't want to find myself buying a stock where the par is at the low points from trading in the last 3 to 5 years. So I think I'm doing okay on both of those concepts. Next slide. Here's the visual analysis from my SSG Plus, and here's the thesis that my investment club is using right now. The behavior health division, the business for behavior health, that's half of Universal Health Services business, is rising. And that is projected to currently rise with there being a lot more behavioral problems being reported and being treated due to the isolation that COVID has created in the last 7, 8, 9 months, and will continue to create until we get everybody out of the house and back to work. The acute care portion of the business, that's the other half, was essentially shut down as the hospitals and clinics moved towards treating COVID patients. So that business, a lot of it very needed kinds of surgery, needed kinds of treatments was all postponed. I don't think it's going to go away. I don't think the need for a lot of that surgery is going to go away. And at some point, once we get past the COVID, and we seem to have freed up our hospitals now so that they're able to do more surgeries that are at your own choice rather than emergency kind of work. That seems to be opening up the units again, and the business seems to be catching up, albeit slowly, but it seems to be doing that. We started out looking for companies in 2 industries, either healthcare institutions, which is this particular one right here, or healthcare devices, which would be things like hospital beds or hips or knees for replacement, because we felt both of those had been shut down really hard, and they would come back a little bit faster and harder than you might expect because of pent-up demand. This is healthcare institutions. Again, it's small hospitals, surgery centers, outpatient clinics, and they seem to be on par right now for their business to be improving. Those dots that you see into the future there are coming from Morningstar, and they're just suggestions as to what Morningstar feels earnings and revenue should be going forward for this year and then the next 2 years. Our thesis in the investment club that owns this is that we should be back up to trend sometime within the next year, year and a half, or 2 years. And once we get back up to trend, we feel this stock has a lot to offer it. Notice we're buying it at a price that's lower than it's been in the last 3 years. That red tick mark right there is showing me the current price. And if you follow that across to your left, you'll notice that it hasn't been that low except for in 2017. So it should be a good price to buy it at. And then, of course, you need to have some patience for the business to recover. Next slide. I did an SSG based on revenue growth of 6.5%, earnings growth of 9%, PE judgments of a low of 10 and a high average of 16, which gives me an average PE of 13. The 20-cent per share dividend has been suspended for this quarter and next quarter. Going into the shutdown, going into the COVID crisis, the company did suspend its dividend, but it made all kinds of noises as if it was going to resume its dividend starting in 2021. I take them at their word, although they haven't actually said it in that many words. I'm reasonably certain that I'll see the dividend return. It's a relatively small dividend that adds less than 0.5% to the return value. Next slide, please. We're ready. I suggest Universal Health Services to add to our round table. That's pretty nice par values, 12.3, maybe as high as 17. And I'm going to move to our polls right now so that we can see what you folks think. If you give me just a second here so I can find them. And let's launch it. There we go, folks.
We're doing pretty good on time, Ken, so.
We'd like to get about 75 or 80% of you voting if we could. Voting's already up to 75%, so I'll give it about 8 or 10 more seconds here, and then I'll shut it down.
Everybody's welcome to vote, if you're here for the first time even.
Okay, I'm going to close the poll, and I'm going to share the results. Pretty close race this evening, Mark. I don't know if you want to add 2 holdings tonight or just keep it to the one for Universal Health, but Universal Health, about a third of you, and slightly less than a third of you think Truist Financial is the best choice out of the group. Sirius coming in third with about a fifth of the votes and about a tenth of the votes going to BP, and 5% of you don't like any of them. So.
Well, I'm inclined to go ahead and those two are close enough within the margin of error in this presidential season that I think we should go with the top 2 selections. Plus, I just have a feeling that the audience is about to heat up in their selections.
Okay. So I have no problem then adding $1,000 in audience money to Universal Health Services and to Truist Financial. Let me hide this poll and we'll go back to where we were with, you can go to the next slide then, Mark.
Okay, thanks, Ken. All right, some stuff coming at you. Again, I mentioned that we are doing the bull sessions. It's on Tuesdays at 2. That is during the work day for some people, and we do record the sessions. I'll show you where to find those here in a second. The October roundtable, again, will be on the last Tuesday in October, October 27th. That'll be our Halloween session. I would suspect that we'll probably see some small company activity in the selections next month, but we'll see. You never know where these guys are. This is like herding cats, guys. I never know where these guys are going to go. All right, and as Ken has already mentioned, we're looking at a COVID-2 cancellation conference. The Mid-Michigan Stock Pickers Breakfast will be replaced, I think, in a good way, with a Successful Investing 2 set of sessions. And on the stock panel will be the 4 of us, along with the aforementioned Pat Donnelly, Kim Butcher, who wasn't able to be with us here tonight, and Herb Lemcool. And we'll put together a program of opportunity and exploration, and we look forward to sharing that with you. Any thoughts on that?
And Mark, we got a couple of questions asking folks that aren't in the Mid-Michigan chapter, asking if they can attend. And of course, all of our friends from throughout the country are free to attend. It's an absolutely free event. We will be contacting everyone on our mailing list, and that comes to about 15 or 1600 people now that Natalie is mailing reminders to, and we'll invite you to the conference, and we'll also make it clear that you can take our URLs, our registration links, and you can send them to anybody else that's not on our registration list. So if you want to send them to your whole club or send them to friends or anything like that, we don't have any problems with as many people coming and listening to what we're going to talk about as want to. That's November 11th, 12th, and 13th. And watch in a couple of weeks for more information in the mail.
Okay, and as the backup plan, if you're unable to attend, and this applies to almost everything that we do, if you go to YouTube and you search for Manifest Investing or Roundtable or any of those type of things, you are presented with all the videos we've done for the last approximately 8 years. There's quite a few here. But all of the roundtables, the bull sessions that we've been doing are investing topics. Ken and I just did investing topics, or actually a two guys presentation for Cleveland that's shown there. And again, we just would encourage you to go there and explore. One of the things that I find really cool that probably applies here tonight is if you go to this page and you actually search on a topic like projected return on value or a particular stock symbol like Air Lease, for example, and you enter that into the search, you will actually be taken directly to the sessions where that stock was featured. And that can be a lot of fun. We'll be demonstrating that at a bull session here fairly soon. And again, we really appreciate your support. If you like what you see and you'd like to be notified anytime that we add to this collection, you click on that subscribe button, and that helps us in a lot of different ways. We are reaching more younger investors and a wider audience, and anything that you do here actually helps us to do that even more. So,
Mark, we are getting a number of questions about what is a bull session, and a bull session is exactly what it sounds like. Every Tuesday at 2 o'clock Eastern Time, Mark and I open up a GoToMeeting. The link is always on the Manifest Investing website, and if you can't find the link, send him an email or send me an email, and we'll be glad to send you a link. And basically, we're just talking about anything that interests us, and we're trying to talk about things that interest our audience as well. We started with about 20 or 22 people at our very first bull session, and we're up into the 60s now. So every week that audience gets just a little bit larger. So give it a try. What do you have to lose except maybe an hour? And if you're sitting at home retired, you have a lot of hours to give to other things. Give it a try. See if you enjoy what we're talking about. And if so, come on back the next week for more then.
Yeah, and as we shut down, I'll go ahead and switch over when we go to open floor session here. But just want to wish everybody a wonderful October, and Ken and I will be feverishly working on the small company selections over the next few weeks, and we appreciate the suggestions and companies for consideration for that also. So I just want to give one big thank you all to your participation in that. Go ahead and close us down, Ken. What are your closing thoughts?
Well, I'm just happy to have the audience that we're having. We've been doing this for more than 10 years. As long as it's a lot of fun for us, we hope that it's a lot of fun for you, and we'll keep doing it. So until October, have a great time out there, and we hope that some of you will save those dates in November.
Thanks. Good night, everybody. And then we will stick around for some Q&A. I'm just shutting down the recording at this point.